February 5th, 2026. COMEX just lost 3 million ounces in a single day. That's not a withdrawal, that's a bank run. But here's what they're not telling you. While New York vaults are bleeding, Shanghai is charging $127 per ounce for the same metal trading at $74 in the West, a 70% premium. That's not a discount, that's a parallel reality. And the math? It stopped making sense 72 hours ago. Welcome to Currency Archive. I'm speaking to the investors who remember when a handshake meant something, when markets operated on reality, not algorithms. If you value analysis that doesn't insult your intelligence, hit that subscribe button. Because what I'm about to show you, the institutions are desperately hoping you'll ignore. And before we dive into the vault carnage, drop a comment below. Tell me where you're watching from. New York, Texas, London, Dubai? Because what's happening in your region's vaults might be very different from what they're telling you on the news. Let's expose the numbers they don't want you to see. February 5th, 2026, a Wednesday morning. The kind of day when most investors check their portfolios over coffee, expecting the usual market noise. But in the registered vaults of the COMEX exchange in New York, something unprecedented was unfolding. 3 million ounces of physical silver vanished from the stockpiles in 24 hours. Not traded, not transferred, withdrawn, gone. To understand why this matters, one must first understand what registered inventory actually means. When silver sits in COMEX registered vaults, it represents metal that backs futures contracts. It's the physical guarantee behind the paper promises traded on screens across the world. It's the collateral that makes the entire system credible. Before February 5th, COMEX held 20 million ounces in registered inventory. After the withdrawal event, 17 million ounces remained, a 15% depletion in a single day. For context, normal daily withdrawals from these vaults range between 50,000 and 200,000 ounces. Market participants take delivery when contracts expire. Refineries move metal between facilities. Industrial users collect their hedged positions. This is standard operational flow. 3 million ounces is not standard operational flow. 3 million ounces represents a 15-fold to 60-fold increase above normal withdrawal patterns. This is not volatility. This is structural breakdown beginning in real time. The analysts at the exchange noticed something else unusual. Futures contract settlement patterns had shifted dramatically. Normally, between 1% and 3% of silver futures contracts settle with physical delivery. The rest close out financially. Traders take profits or losses in cash, not metal. This is how commodity exchanges function. Paper trading dominates. Physical delivery remains the exception. But on February 5th, the physical settlement rate hit 100%. Every contract holder who could demand metal demanded metal. This behavior reveals something critical about market psychology. When traders prefer cash settlement, they trust the system. They believe paper and physical are interchangeable. The price is the price, whether settled in dollars or ounces. But when traders demand physical delivery at unprecedented rates, they're sending a different message. They're saying paper and physical are no longer the same thing. They're saying the contract in their account might not be worth the metal it claims to represent. They're saying, get out while you still can. The business community must understand what this withdrawal represents in practical terms. 17 million ounces sounds like a large number, but silver isn't just an investment asset. It's an industrial commodity with inelastic demand. Electronics manufacturing requires it. Solar panel production depends on it. Medical devices use it. Military applications consume it. Global industrial demand for silver runs approximately 30 million ounces per month. The United States industrial sector alone consumes roughly 8 million ounces monthly. COMEX now holds enough registered inventory to cover 2 months of U.S. industrial demand. If withdrawals continue at the current pace, that timeline compresses to less than 1 week. This creates a strategic question every business decision maker must confront. What happens when an exchange that is supposed to guarantee physical delivery runs out of physical metal to deliver? 3 scenarios emerge. First scenario, withdrawal demand slows and the system stabilizes. Second scenario, the exchange suspends physical delivery and forces cash settlement only. Third scenario, the paper price rises dramatically to ration remaining physical supply. History provides guidance on which scenario is most likely. In 1971, the United States government faced a similar mathematical problem with gold. Foreign governments held dollar claims backed by gold reserves at Fort Knox. When those governments began demanding physical gold instead of accepting paper dollars, the U.S. government faced a choice: deplete the gold reserves to honor the claims or break the convertibility promise. On August 15, 1971, President Nixon closed the gold window. Paper dollars and physical gold were no longer convertible. The Bretton Woods system collapsed. The decision wasn't political, it was mathematical. The claims exceeded the physical supply. The silver market now faces its own mathematical reckoning. COMEX registered inventory, 17 million ounces, outstanding futures contracts representing claims on that inventory, over 200 million ounces. The ratio reveals the problem. There are 12 times more paper claims than physical metal. This works fine when only 1 to 3% of contract holders demand delivery. But when sentiment shifts, when 10% or 20% demand physical settlement, the math breaks. The stockpiles cannot satisfy the claims. The withdrawal event of February 5th, 2026 wasn't a random spike in demand. It was a stress test. And the test revealed a system operating on the edge of failure. 17 million ounces remain. The question isn't whether this is significant. The question is whether those 17 million ounces can survive what's coming next. Because the institutions that withdrew 3 million ounces in one day aren't finished. They're just getting started. And every ounce they remove brings the entire system one step closer to the moment when paper, promises, and physical reality finally separate for good. The depletion has begun. The clock is running. And the business community needs to understand what happens when time runs out. There's a principle in economics so fundamental that it doesn't even need defending. If an apple costs $2 in New York and $5 in London, someone will buy apples in New York and sell them in London until the prices equalize. This is called arbitrage. It's not theory, it's gravity for markets. It works automatically, constantly, without anyone needing to believe in it. Until February 5th, 2026, this principle worked perfectly for silver. Then it stopped. At precisely 9:30 a.m. Eastern Time, COMEX spot silver traded at $74 per ounce. At that exact moment, the same second, Shanghai Physical Exchange spot silver traded at $127 per ounce. The same metal, the same weight, the same purity standard. 71.6% price difference. Every trader on earth saw this gap. Every algorithm flagged it immediately. The arbitrage opportunity was obvious. Buy silver in New York at $74, ship it to Shanghai, sell it at $127, pocket $53 per ounce profit. At scale, this trade could generate billions in pure arbitrage profit. But nobody executed the trade, not because they didn't want to, because they couldn't. The problem wasn't capital. It wasn't transportation costs. It wasn't even the insurance premiums for shipping precious metals across the Pacific. The problem was simpler and far more disturbing. The metal couldn't move. China controls 70% of global refined silver supply through its smelting and refining infrastructure. In late 2025, Chinese authorities implemented export restriction policies on refined silver. The official explanation cited domestic industrial demand and strategic commodity security. The practical effect was immediate. Silver refined in China stays in China. This created the first half of the pricing wall. The second half came from London. The London Bullion Market Association, the institution that sets global precious metal standards, made a quiet technical decision. Silver delivery bars refined in Shanghai would no longer be accepted for settlement in Western markets. The stated reason involved refining standards and chain of custody verification procedures. The practical result was immediate. Eastern silver cannot settle Western contracts. Western silver cannot enter Eastern markets at scale. 2 separate markets, 2 separate prices. Arbitrage didn't fail because traders were slow. Arbitrage failed because the bridge between markets was deliberately destroyed. This is where most market analysis stops. Analysts point to Chinese export restrictions. They mention LBMA technical standards. They treat this as a temporary trade policy dispute that will eventually resolve. But the business community needs to understand something more fundamental. This isn't a policy dispute. This is a controlled demolition of global price discovery. Here's what that means in practical terms. A solar panel manufacturer in California needs silver for production. That manufacturer checks the COMEX price, $74 per ounce. The manufacturer's purchasing manager secures a futures contract, locks in the price, and schedules delivery for next month. The contract legally guarantees physical delivery at $74. But when delivery time arrives, the vault has no metal. The contract forces cash settlement instead. Now the manufacturer must buy physical silver on the spot market. The only available supply is in Shanghai at $127 per ounce. The contract said $74. The reality costs $127. The manufacturer's entire cost model just exploded. This scenario isn't hypothetical anymore. Treasury managers at electronics firms are already receiving force majeure notices from suppliers. Delivery contracts are being voided. Insurance premiums for silver shipments have increased 300 to 400% in the past 90 days. Businesses that operate on fixed-price contracts are discovering those contracts are worthless if the supplier cannot deliver the underlying commodity. Meanwhile, the COMEX exchange itself took action. On February 3rd, the CME Group announced the third margin requirement increase in 10 days. Margin requirements for silver futures contracts increased 20%. In traditional risk management, exchanges raise margin requirements when prices are rising and volatility is increasing. More price movement means more risk means more collateral required. but silver prices were falling when CME raised margins. This is the inverse of standard risk management protocol. The purpose becomes clear when you understand the mechanics. Raising margin requirements forces leveraged traders to post more collateral. Traders who cannot post additional collateral must close their positions. Closing long positions means selling contracts. Mass selling drives paper prices down. Lower paper prices make the physical paper divergence even wider. This isn't risk management. This is price suppression executed through exchange policy. Two markets now exist where one market used to function. Paper silver trades in New York at $74. Physical silver trades in Shanghai at $127. The mathematical impossibility is obvious. Either the paper price rises to meet physical reality, or the paper price becomes completely irrelevant. And when paper prices become irrelevant, every business hedging strategy built on those prices collapses. Every supply contract based on exchange prices becomes unenforceable. Every treasury model assuming price correlation breaks. The divergence isn't temporary market inefficiency that arbitrage will eventually correct. The divergence is the market screaming that paper contracts and physical metal are no longer the same asset. And once that separation becomes permanent, there's no mechanism to put them back together. The bridge is gone. Two islands remain. And business leaders must now choose which island their operations can actually survive on, because paper promises don't manufacture solar panels. Physical metal does, and physical metal now trades in a completely different reality. There's a moment in every market crisis when the authorities reveal whose side they're on, not through press releases or policy statements, through action. February 5th, 2026 provided that moment for the global silver market, and the actions taken on opposite sides of the planet told two completely different stories. Shanghai, China, 10:47 a.m. local time. The Shanghai Futures Exchange published official notice 2026-37. The document was brief, technical, and devastating. 6 groups of linked institutional accounts had been caught exceeding intraday position opening limits on silver contracts. The exchange imposed immediate restrictions. These accounts could no longer open new positions. They could only close existing ones. The announcement didn't mention names. It didn't need to. Market participants understood exactly what had happened. Someone had dumped 674 million ounces of paper silver onto the Shanghai market in a single morning session. To contextualize that number, global mining production for an entire year totals approximately 355 million ounces. In one morning, someone sold nearly double annual global mine production. This wasn't trading. This was an attack. The Shanghai Futures Exchange saw the attack unfold in real time. The algorithm patterns were obvious. The coordination was blatant. The linked accounts moved in synchronized waves. And unlike their Western counterparts, Shanghai regulators responded immediately. They didn't study the situation. They didn't form committees. They didn't wait for the crisis to deepen. They severed the attack at its source within hours. Now shift continents. New York. COMEX exchange headquarters. The same day, different response. While 3 million ounces physically drained from registered vaults, while settlement demand hit unprecedented levels, while the gap between paper and physical prices reached 70%, COMEX raised margin requirements. Again, for the third time in 10 days. Here's what makes this response pattern so revealing. And when Shanghai detected market manipulation, they banned the manipulators. When New York detected market stress, they made it more expensive for traders to hold long positions. One exchange protected market integrity. The other exchange protected the short sellers. The business community needs to understand what margin increases actually accomplish. Imagine a manufacturer holds silver futures contracts as a hedge against rising input costs. Those contracts are leveraged. The manufacturer doesn't pay full price up front. They post margin, typically 15 to 20% of contract value. When the exchange raises margin requirements from 15% to 20%, the manufacturer must immediately post additional collateral. If the manufacturer cannot post that collateral within 24 hours, the exchange liquidates their position automatically. The contracts get sold, the hedge disappears. Now multiply that scenario across hundreds of institutional accounts. Pension funds holding precious metals allocations, manufacturing firms hedging input costs, small refineries protecting against price volatility, all holding leveraged long positions, all receiving margin calls simultaneously. Most cannot post additional capital on 24 hours notice, so the exchange force liquidates their positions. Forced selling drives prices down. Lower prices trigger more margin calls. More margin calls create more forced selling. This is called a cascade. And it's precisely what happens when you raise margin requirements during falling prices instead of rising prices. The pattern reveals intent. If COMEX wanted to stabilize the market, they would have investigated the withdrawal surge. They would have questioned why settlement demand increased 33 to 100 times normal levels. They would have examined whether the remaining 17 million ounces could actually cover outstanding contract claims. Instead, they made it harder for anyone betting on higher prices to maintain their positions. Meanwhile, the divergence widened. Shanghai physical, $127. COMEX paper, $74. The gap wasn't closing, it was accelerating. And the regulatory responses were pushing markets further apart, not bringing them together. There's a term in game theory called revealed preference. It means you ignore what someone says and watch what they do. Actions reveal true priorities. Shanghai's actions revealed a priority to maintain physical market integrity, stop the manipulation, protect price discovery, ensure real metal backs real contracts. New York's actions revealed a different priority, suppress paper prices, protect short positions, keep the leverage system functioning regardless of physical reality. For business leaders managing supply chains, this creates an impossible strategic problem. Which market do you trust? The one that enforces delivery and punishes manipulation, or the one that raises margins and forces liquidations? The one trading at $127 with physical backing, or the one trading at $74 with depleting vaults? Here's why this matters beyond silver specifically. When regulatory bodies stop maintaining market integrity, participants lose faith in the system. When participants lose faith, they demand physical settlement instead of accepting paper promises. When everyone demands physical settlement simultaneously, the mathematical impossibility becomes operational reality. The vault's empty. The contracts fail, the system breaks, and it's already happening. February 5th wasn't the beginning of the crisis. It was the day the authorities chose sides. Shanghai chose physical integrity. New York chose paper preservation. One of these choices leads to short-term pain and long-term market credibility. The other leads to short-term stability and catastrophic systemic failure. The institutional response pattern tells business decision-makers everything they need to know, not about silver prices, about which markets still function as actual markets, and which markets have become policy tools designed to maintain an illusion. Because when regulators protect manipulators instead of punishing them, when exchanges suppress price instead of discovering it, when paper promises receive more protection than physical delivery obligations, the market isn't broken. The market is working exactly as designed. It's just not designed to serve the people who think contracts still mean something. It's designed to serve the institutions that need those contracts to fail quietly. And quietly is no longer an option. The noise is deafening. The question is who's listening? This is not investment advice. This is operational risk assessment. There's a critical difference. Investment advice tells someone whether to buy or sell an asset for profit. Operational risk assessment tells a business whether their supply chain will still function 90 days from now. Every business leader reading this needs to understand that distinction immediately. Because what's happening in the silver market isn't a trading opportunity. It's a warning signal for something far larger breaking down across commodity markets globally. Start with the immediate risks. Any manufacturing operation using silver-intensive components faces delivery failure risk right now. Electronics assembly, solar panel production, medical device manufacturing, automotive sensors, military-grade communications equipment. These aren't luxury goods. These are industrial necessities with no substitute materials available at scale. Silver's unique properties, highest electrical conductivity, highest thermal conductivity, highest reflectivity of any metal, make it irreplaceable in these applications. Here's the supply chain reality most procurement managers haven't confronted yet. A business signs a fixed price contract with a supplier for silver-containing components. The contract specifies delivery dates, quantities, and prices based on COMEX futures pricing from when the contract was signed. 3 months pass. Delivery date arrives. The supplier invokes force majeure. They cannot obtain physical silver at the contracted price. COMEX paper silver trades at $74 per ounce. Shanghai physical silver trades at $127 per ounce. The supplier's contract specified COMEX pricing, but COMEX has no physical metal to deliver. The only available metal trades in Shanghai at 71% premium. The supplier has two choices: breach the contract and face legal consequences, or fulfill the contract at a 70% loss and go bankrupt. Most suppliers will choose the first option, which means the manufacturer receives no components. Production stops, revenue disappears, all because the underlying commodity market stopped functioning as a market. This scenario is already unfolding. Treasury managers at Fortune 500 electronics companies have received force majeure notifications in the past 30 days. These aren't warnings. These are actual contract breaches happening right now. The business media hasn't reported it widely yet because companies don't announce supply chain failures until they must. But the procurement managers know. The CFOs know, and the smart ones are already rewriting their operational risk models. The second-order effects spread beyond silver-intensive industries. When one commodity market's price discovery mechanism fails, other commodity markets watch closely. Copper prices are showing early signs of physical paper divergence. Platinum supply chains are tightening. Palladium inventories are declining. Nickel markets are experiencing similar vault depletion patterns. Here's why this matters systematically. Modern industrial civilization runs on commodity markets that function properly. Price discovery tells manufacturers what things cost. Futures markets let businesses hedge against price volatility. Physical delivery guarantees ensure contracts have meaning. When those three mechanisms work, global supply chains operate smoothly. When any one of them breaks, friction increases. When all three break simultaneously, supply chains seize. The historical parallels are precise and terrifying. 1971, the United States couldn't deliver gold at the contracted price of $35 per ounce. Foreign governments demanded physical delivery. The U.S. government closed the gold window instead. The Bretton Woods international monetary system collapsed overnight. Currencies began floating freely. Inflation accelerated globally. The world entered a decade of economic chaos. 2008, credit default swaps were supposed to insure against bond defaults. When actual defaults occurred, the insurance couldn't pay. The notional value of derivatives vastly exceeded the underlying assets. The mathematical impossibility became operational reality. Financial institutions collapsed. Governments intervened with trillions in bailouts. The global economy nearly seized completely. 2026, silver paper contracts claim to represent physical metal. Physical delivery demand is testing that claim. The vaults are emptying faster than they can be refilled. The notional silver in futures contracts exceeds physical supply by 12 to 1. History doesn't repeat, but it certainly rhymes with mathematical precision. Business leaders must now answer three critical questions. First, how much does your operation depend on silver-intensive inputs? If the answer is significantly, you're exposed. Second, can your suppliers actually deliver physical metal, or are they holding paper contracts? If they're holding paper contracts, those contracts may be worthless. Third, what jurisdictions still have physical supply available for purchase at any price? If the answer is only Shanghai at 70% premium, your cost model just exploded. The decision framework is brutal but simple. Companies that recognize this structural breakdown early can renegotiate contracts before panic spreads. Companies that wait for mainstream financial media to report the crisis will be last in line for remaining physical supply. By the time CNBC runs headlines about silver shortages, the available inventory will already be claimed. Here's the math that cannot be argued with. COMEX registered inventory, 17 million ounces remaining. Average daily withdrawal rate, 3 million ounces per day. Simple division, 17 divided by 3 equals 5.6. At current withdrawal rates, COMEX has 5.6 days of inventory remaining. Three outcomes are possible. Outcome 1, withdrawal demand slows dramatically and the system stabilizes. This requires institutional actors to suddenly trust paper contracts again despite evidence those contracts cannot be fulfilled. Probability, low. Outcome 2, COMEX suspends physical delivery and forces cash-only settlement. This destroys market credibility permanently, but preserves the exchange's operational existence. Probability, moderate. Outcome 3, paper prices rise explosively to ration remaining physical supply until new supply enters the market. This means $74 silver becomes $127 silver overnight in Western markets. Probability, high. None of these outcomes benefit businesses operating on thin margins with just-in-time inventory models. All three outcomes create severe operational disruption. The only variable is timing. The strategic warning is complete. Business leaders don't need to believe any particular market narrative. They don't need to have opinions about monetary policy or geopolitical commodity control. They just need to answer one question, honestly. What happens to your operation if silver-containing components become unavailable at any price for 90 days? If the answer involves production stoppage, revenue loss, or existential business risk, then the time for contingency planning isn't next quarter. It's today. Because when stockpiles vanish, supply chains don't care about paper prices. They care about whether the metal actually shows up. And right now, the metal isn't showing up. The vaults are bleeding, the contracts are failing, and the institutions that were supposed to guarantee delivery are raising margin requirements instead. The warning has been issued, the math has been shown. The decision now belongs to the people whose businesses depend on physical reality, not paper promises.